This is unit number 8, absorption and marginal costing. In the previous video, we have seen the definitions of marginal costing and absorption costing, the difference between marginal costing and absorption costing, and how to prepare an income statement using both these types of costings. In this video, we are going to see this topic, segregation of semi-variable costs. Semi-variable costs means those costs which have both fixed component and variable component, means fixed costs are there and variable costs are also there. In such cases, how to segregate, how to divide variable costs separately and how to find them. So that is the topic for this video. Let us jump to the topic. Right. Segregation of semi-variable costs. As explained earlier, marginal costing method requires segregation of all costs into two parts, fixed and variable. In the previous video, we have seen what is marginal costing. Marginal costing in the preparation of income statement at the step number 2, where we find out cost of goods sold, it takes only variable costs into consideration. It does not take fixed costs into consideration. Whereas the absorption costing takes both the costs. In marginal costing, the fixed costs will be taken separately at step number 4 or step number 5. So at step number 2, for determining the cost of goods sold, only variable costs are considered. This means that semi-variable costs will have to be segregated into fixed and variable elements. Suppose, for the sake of examination or for the sake of understanding this chapter, question will be given like this. This is the fixed cost, this is the variable cost. But normally, in the real-time scenarios, what happens is businesses will use different kinds of methods for identifying the variable costs. We are going to study those kinds of methods in this video. Here, 5 types of methods are there. Levels of output compared to levels of expenses method, high-low method, degree of variability method, scatter graph method, and least squares method. These are the methods which are used to identify the variable component of the cost. There is an illustration given here. In July 2002, a company produced 100 units of items or goods, and semi-variable expenses for these 100 units is 300 rupees. See here, the term expenses is used. There is a slight difference between expenses and cost. The difference is, cost means the actual amount paid for acquiring an item. Suppose a business is purchasing a machinery. The amount paid for purchasing that machinery is the cost of that machinery. In the particular financial year or in a particular period, if the machinery is used only to a particular extent, then that utilized part is called the expense. Expense means how much of the cost is actually utilized in the business for generating revenue. Expenses will be matched with the revenue, whereas cost is not. Depreciation is an expense. Okay? Now, here production for different months in a company is given, and semi-variable, actually it should be cost, not expenses. Okay, we will use interchangeably cost or expense. Let us not be bothered about the terminology. We will get straight into the understanding of the topic here. The semi-variable costs for each month is also given. Now, how these levels of output method and levels of expenses method finds out the variable part of the semi-variable expenses. Semi-variable expenses means nothing. Fixed component plus variable component together is semi-variable expense, or you can call it total expenses. In the total expenses, how do we find the variable part? Okay. This method says that levels of output to levels of expenses. This method says that you find out the change in the output. From 200 to 140, 60 units are decreased from November to December. In the same month, from November to December, expenses also reduced from 460 to 380. This means that for a 60 unit reduction in the output, there is a reduction of 80 rupees in the expenses. Since fixed expenses will not change, it is only due to the change is only due to the change in the variable expenses. That is the concept of this method. Okay. The difference in output at two different points of time is compared with the corresponding difference in expenses. Difference in output compared with the difference in expenses. Since the fixed portion of the expenses remain constant, any increase or decrease in total expenses must be attributed to the variable portion only. If there is a change in expenses, whether there is an increase or decrease, it must be only because of the variable expenses. The variable cost per unit can be derived by dividing the difference in total expenses with the difference in level of output at 2 points of time. See the example given here. For September and November, there is an increase in the production of 40 units, whereas the expenses increased only by 60 units. For 40 units increase in production, expense increased by 60 rupees. So for each unit of increase, there is an increase of 1.5 rupees in expenses. So this 1.5 rupees in expenses for each unit is nothing but the variable expense. Okay. So in the month of September, total expenses is 400. Total production is 160. You multiply with this with variable expenses. Variable expenses is 1.5 rupees for each unit. 160 units are produced. 160 into 1.5, it will be 240 rupees. So remove 240 from this total expenses. 160 will be the variable expenses. That is the example given here. Okay. Variable overheads for September equal to 160 into 1.5. How did we get this 1.5? You divide increase in the expenses by increase in the number of units produced. Then we will get for each unit how much is the increase. This is 1.5. Multiply this with the total number of units. We get 240. So total expenses is 400. Remove this 240. You will get 160 rupees. Like this, the question asked, find the variable expenses for the month of January. You can find similarly. Right? What is the second method? HighLow method. Okay. In this first method, levels of expenses method, we will compare production for each month, July to August, August to September, September to October, October to November, and November to December. Like this, month wise, preceding or succeeding month, we will compare and we will arrive at the corresponding change in the variable expenses. Whereas this HighLow method, we do not compare each month. We will take the lowest value. For example, August is the lowest production, 60 units. What is the highest production? 200 units. November is the highest production. So what is the difference from August to November? 140 units are increased. Corresponding increase in expenses is 264 to 460, means around 136 units are increased. Okay. So for 140 units of increase in units from August to November, the expenses increased only by 136 rupees. The same is given here also. HighLow method. Only the highest and the lowest levels of output are considered out of various level. Here we will take August and November only. This is the lowest production. November is the highest production. I said 136, no? It's 196. My calculation was wrong. Okay, no problem. You try to understand the point that I am trying to say. Therefore, variable element for each unit, for 140 units, the increase in price is 196 units. So for 1 unit, how much is the increase? 196 divided by 140, that is 1.4 per unit. From this one, we can calculate the variable expense. In August, 60 units are produced. 1.4 into 60 is the total variable cost. Remaining is the fixed overhead cost. 264 minus 80, 84, 180. Like this, we can calculate variable costs for other months also. The HighLow method takes into consideration 2 sets of data instead of all the data. The 2 sets of data are the high cost point. In this example, it is August, so November, and the low cost point, it is August, relating to a specific measure of output. As the results in HighLow method are based on observation of extreme data, the results may not be very accurate. This method does not give accurate results because we are taking only 2 points of data. One is highest data and there is the lowest data. Here we are taking production of units. We have considered only November's production 200 units and we have compared it with the August's production, which is 60 units only. So this does not give the appropriate figure of the variable costs. Now we'll see the next method. This is degree of variability method. This is nothing but a percentage will be given. For these items, the variable costs will be 40%, variable costs will be 60%. Like that, the degree or percentage will be given directly. In this method, degree of variability is estimated for each item of semi-variable expenses. Some semi-variable items may have 40% variability, while others may have 60% variability. So the portion of variable expenses will be given in percentage. For example, assuming the degree of variability is 60% in semi-variable expenses for some items and taking the month of October as a basis, the analysis can be done as under. For the month of October, total expenses is 340 rupees. Fixed plus variable together it is 340 rupees. Out of this, the question says that, or the company says that, it is only 60% of this total expenses belongs to the variable expenses. Therefore, variable expenses will be 60% into 340, it will be 204 rupees. The remaining 40% is the fixed element. 40% into 340, it gives 136. Similarly, we can find for the other months also. This is a simple method. Directly percentage will be given. You have to find out fixed part and variable part. Okay. The next method is scatter graph method. In this method, the given data are plotted on graph paper and the line of best fit is drawn. Okay. A new term is used here, line of best fit. We will see what it is. The volume of production is plotted on the horizontal axis and the costs are plotted on the vertical axis. See here, there is a graph drawn here. This is number of units produced for each month. 0 units, 20 units, 40 units, 60 units. And this one is costs, semi-variable costs or total costs, fixed plus variable costs, 100 rupees, 200 rupees, 300 rupees, 400, 500, 600. These two are drawn. For this one, we will take the data given above. 20 units, 210 rupees is the cost. 40 units, 280 or 290. 60 units, 350 rupees. 80 units, 400 rupees. 100 units, 450 rupees. Means this is the data. One x point, one y point. x1, y1, x2, y2, x3, y3, x4, y4, x5, y5, x6, y6. 6 different data is given, and for each x point, the value of y is also given. What we have to do is to find a straight line passing through all these points. It may not be possible to draw a line directly like y is equal to mx plus c. We have to find out the best fit. If only 2 points are given, only 2 data points are given, x1, y1 and x2, y2, then it is very easy to find out a straight line passing through those 2 points. y2 minus y1 by m2, x2 minus x1, it will give the slope of the line. Then we can prepare a straight line y is equal to mx plus c, where m is equal to slope. Slope means y2 minus y1 by x2 minus x1. Whereas here so many points are there. For different production, different expenses. For different if the production is increasing, expenses are also increasing. Sometimes production is increasing, sometimes expenses are decreasing. Like that, many points are there. And for those points, we have to find out a best line. And when that line is drawn, the point where it intersects the y-axis means when x is equal to 0, means when the production is 0, at which point this straight line intersects the y-axis, this point is the fixed cost. Fixed costs, as we have seen, the definition says that these are the costs that do not depend on the output, that do not depend on the volume of the output. Irrespective of the output, these costs will be incurred. Whether you produce something or not in the business, these costs are going to occur in your business. Suppose if the production is 0, but still you have to set up the office, you have to pay the electricity, you have to pay the pay for insurance, you have to pay salaries, you have to pay wages. So different fixed costs are there. These costs will be incurred irrespective of the output. So when x is equals to 0, means if the output is equals to 0, whatever costs are incurred, this is that point. This is the fixed cost point. Now, if we draw a straight line parallel to this one, this line is called the fixed cost line. For 20 units, for example, let's say this is 220. So, for 20 units, the output, the fixed expenses is 220 rupees. Whereas the fixed cost is 190. Say for example, it is 190. The difference between fixed cost and variable cost is, this is the variable cost. I'm sorry, this is the total cost. Total cost is not, sorry, no, I got confused here. Semi-variable cost means this is the total cost. The difference is the variable cost. For 20 units, the total cost is, for example, if we take it as 240 units, then 240 minus 190, 50 rupees will be the variable cost. For 40 units of production, if the total cost is 280, for example, if we consider it as 280, then 280 minus 1, if it is 190, 280 minus 190, 90 rupees will be the variable cost. The difference between this point and this point will be the variable cost. This is called the straight line or a line of best fit method. We will prepare a graph. This graph is called scatter graph, and using this graph we will find out the variable cost. A straight line of best fit is drawn through the points. What are these points? These points are number of units produced and total expenses, x1 and y1. This is the total cost line. The point where this line intersects the vertical axis is taken to be the amount of fixed element. Y means when it is intersecting the vertical axis, at that point x is equals to 0, which means x means number of produced units. When the output is 0, we will incur only fixed costs. Means even if the output is also 0, we are incurring fixed costs. That point is considered to be the fixed cost. A line parallel to the horizontal axis is drawn from that point where the line of best fit intersects the vertical axis. This is called the fixed cost line, this one. The variable cost at any level can be known by noting the difference between the fixed cost and the total cost. This is the total cost. These points are all, y points are total cost points and x points are this one, production units, and intersection point is the fixed cost. This fixed cost minus total cost or total cost minus fixed cost, the difference will give the variable cost. Okay. The next method to identify variable cost is method of least squares. This is just an extension to this one. Suppose we have a data x1, y1, x2, y2, x3, y3, where x1 is the number of units of production, y1 is the total expenses incurred for generating that many units. We have to find a line, best fit line, passing through all the points. It is a very difficult statistical regression analysis has to be done to find out a best fit line. So this is one of the methods. Least squares method is one of the methods to find out that best fit line. A straight line equation is y is equals to mx plus c. This we have studied in our school. Same is given here. Y is equal to a plus bx. y1 is equal to a plus bx1. y2 is equal to a plus bx2. For different points, the equation goes like this. y3 equals to a plus bx3. y4 equals to a plus bx4, like that yn is equals to a plus bxn. If you add all these equations, we will get sigma y is equals to na plus b sigma x, right? Now multiply this with x. We will get sigma xy equals to a sigma x plus b sigma x square. This n will not be there. A sigma x plus b sigma x square. So using these two equations, we will find the values of a and b. This is called least square methods, which is used in regression analysis for finding out a straight line which passes through all the points. The equation is nothing but this equation, y is equals to a plus bx or y is equals to mx plus c, which represents the input production, output production and the total expenses incurred. Suppose for x1 and y1, for example, say 20 and expenses is 400, x2 and y2 40 and 500, x3 and y3 50 and 600, like that many different points are there. We have to find out an equation y is equals to mx plus c, which is passing through or at least closest to all the points. Okay, this is the statistical method for finding out such line. The data is given like this: x point, y point, output production, total expenses, output production, total expenses, x2, y2, x3, y3, like this. Different number of points are there. We add all the x points, sigma x, we add all the y points, expenses, sigma y, we square this one, sigma x square, and we multiply xy, we get sigma, and add all those things, we get sigma xy. Now using these points, we will try to find the equation. We have got these equations. Now ignore this part. This part is a little bit confusing. You take only this part. Y is equals to a plus bx. Add all the points. We will get sigma y is equals to na plus b sigma x. Multiply with x. We will get sigma xy equals to a sigma x plus b sigma x square. Now we have to find out a and b using these two equations. First we have arrived at sigma x, sigma y, sigma x square and sigma xy from the given data, and then we will substitute those values in these two equations. Putting the values in these equations, we will get sigma y, n means 6 different points are there, 6a, plus sigma x is 780, bb, and sigma xy is this one total. A sigma x means sigma x total is 780 multiplied by a plus b sigma x square. From this, you multiply this 60 into 130, this above equation with 130, and subtract from second equation and first equation. Then we will get the value of b. B is equals to 1.45, and substitute b value in this here. We will get a value. A value will be 168.x3. Like this, we will get a values and b values. The equation is the best fit equation, which is passing through all these data points. These data points is y is equals to 168.83 plus 1.45x. Okay, this 168.83 is called the fixed cost. Okay, because when x is equals to 0, what did we get here? When x is equals to 0, this line is intersecting the y-axis. This intersection point is called the fixed cost. Therefore, this value when x is equals to 0 is called the fixed element. The remaining part is called the variable element. Okay, after putting the value of, for example, for the month of January, it was given that 80 units are produced, means x value is given. Production is represented in the x side, x axis, and we want to find out the semi-variable part. The semi-variable part can be found out using the y value. Okay, y is equals to fixed costs plus 1.45 times of number of units, that is 284.83. In this way, using the least squares method, we can also find out the variable cost. Okay, this is about finding variable costs. In the next video, we will see what is the next topic? Contribution. This is like a gross profit. Okay, contribution, and then we will go to break-even analysis. I hope you understood about this finding out variable costs, different methods used for finding out variable costs. Stay tuned for other videos. Bye bye.